Okay, this video is about computing the rate of return and evaluating the risk on a portfolio of investments, not a single investment, but a portfolio. In this case, we're going to use publicly held mutual funds that anyone can go buy. Mutual funds are collections of stocks and or bonds, and you buy a share of the mutual funds, in which case you're actually buying a little bitty share of all the stocks or bonds that the mutual fund holds. That's good in that it's diversified, as opposed to buying the stock of an individual company. So let's go through this sample portfolio. It's got 4 investments. The first one is S&P 500 index fund. That's a mutual fund of the largest 500 companies in the U.S., not the absolute largest, but 500 large companies selected by Standard & Poor's. That's just a company that creates indexes and does a lot of other things as well. But this is a well-known index of large U.S.-based companies. And in this portfolio, 45% is in the large company index fund. This is also equities or stocks. You used equity and stocks, those terms interchangeably. But this is small cap, which cap means capitalization. That means the total market value of the stock. So these are smaller companies. I believe this index that it attempts to track is the Russell 2000. I'm not sure about that. You could look it up. And by the way, these are the exact ticker, they call it. 5-letter identifiers for each of these investments, so you could go look up data, any additional data you wanted by using these tickers. So this is smaller companies and U.S.-based companies as well. 23% of this portfolio is in that small cap index fund. And then this is a bond index fund. So bonds are fundamentally different than stocks. Stocks, you actually own a piece of the equity of the business. Typically, stocks don't promise. The company that you own a share of stock in doesn't promise any particular return on that investment. It depends how well the company does and how the stock market goes. So stocks can be quite volatile. The value of a stock can change quite a bit day to day, hour to hour, minute to minute. Bonds are loans, essentially, that the company has taken out. And so the company is borrowing money from the mutual fund and indirectly from whoever owns the mutual fund. And the company says, we'll pay you X% interest over Y number of years. And this is a lot less risky because it has for 2 reasons. One, it has a stated rate of return. And 2, typically companies have to pay their bonds first before they pay stockholders, or stated differently, if they're in default on their bonds, they're not making the required payments of principal and interest. Normally the agreements are they can't pay anything to the stockholders. So the bondholders are higher in priority in terms of payment, and therefore it's much lower risk. There's a promised rate of return. You'll never get more than that promised rate of return, but of course the company could default, meaning they don't pay as agreed, and you could end up not earning the stated rate of return. But you're sort of capped out on the maximum return you can get on bonds. And then this is cash. It's like cash in a checking account at a bank. We're assuming there's no interest earned on that. There actually is a tiny little bit of interest, but we're assuming no interest on that, and that the cash is essentially no risk, no return, no risk. And there's 2% of this portfolio in that, 30% in bonds, 23% in small cap stocks, and 45% in large cap stocks. So that's what this portfolio is made up of. Let's turn to the return issue. What's the return on each of these investments? Well, for stocks, that's a tricky question. Because, as I said earlier, stocks don't promise any particular return. Depends how well the company does. It also depends on how the overall stock market does. And so stocks are quite volatile. And but we want to estimate a return. One way to do that is look historically, look backwards to see what the return has been on this investment if you'd held it over the last, pick a period, 3 years, 5 years, 10 years, 15 years, 25 years. There's a forward way of estimating the return that we'll talk about in a minute. But for now, let's just look at the historical. I went online to Charles Schwab and got the 10-year return on each of these investments. 10 years is got a down cycle because 2009, of course, stock market was down significantly, and it's got an up cycle. There was data available going back 15 years, which would, the longer you go back, is probably more representative of the long-term return. But we'll just use the 10-year return numbers for this example. And this return is an annualized return, so it's not 14.9% from the beginning of the 10-year period to the end of the 10-year period. That is an annual compounded return. And that includes both dividends, the company, in the case of the stock funds, dividends the company paid over that period, so cash they paid out to shareholders if they paid any cash. Some stocks don't pay any dividends. They keep all the money within the company to grow the company more quickly. But some of particularly these larger companies, will pay out some cash to shareholders. So it will include dividends and just the change in the value of the stock on the stock market. And the bond funds are a little bit different, but basically the same thing for reasons we won't get into now. The value of bonds can change like stocks. Bond values, unless the company is in very bad shape, don't typically change nearly or not nearly as volatile as stocks, but the value of the bonds can change. But most of this return is in the cash paid out, the interest they pay to the bondholders, typically. And for this purpose, we're assuming the cash, just cash in a bank account, has no return. So in looking at this, we can see the big companies' stock fund returned 14.9% over the last 10 years. The small company, 16%, so more than the large company fund. We'll discuss that in a minute, why that makes sense. And then the bond fund returned far less than either of these at 3.5%. So we'll also discuss that. So that's the return. So if you wanted to compute the return on the whole portfolio, you just do a weighted average of these numbers. And you could compute the weighted average return of the portfolio. So let's talk about risk. You never want to talk about investments and talk about just return. You always want to figure risk into the equation. So lots of different ways to measure risk. I've got two here. First, beta. This is common. I got this beta for the bond fund, but I think I'm going to mark it out for now because that's not commonly used. But for stocks, beta is a measurement of the volatility of the particular investment versus the overall market. So this S&P 500 index fund, typically the overall market is considered large capitalization companies. So it's almost by definition that this S&P 500 index fund has a beta of 1 because it represents the overall market. But what 1 means is if the overall market goes up 5%, then typically this mutual fund would also go up 5%, 1-to-1 correlation. By the same token, if the market goes down 5%, typically this fund would also go down to 5%. So this beta of 1 is saying this investment should move in sync with the overall stock market. So another way to look at that is you could say it is average risk relative to the stock market, not average risk relative to other types of investments like bonds, but average risk relative to the stock market, overall stock market. you can see the small cap fund has a beta of 1.2. So that means it's 20% more volatile on average. There's this statistical process that you go through to get these numbers. But typically, the small cap fund would be 20% more volatile. So that means if the overall market goes up 10%, typically these stocks would go up 12%. If the overall market drops by 10%, typically these stocks would go down by 12%. So they move typically in the same direction as the overall market, but will be more volatile, will move farther up and down. This computed a beta against a bond index fund. That's not commonly used. It was 1.02, which would mean this fund is about average risk for bond fund. But I'm going to mark that out because typically people are thinking, when they discuss betas, they're thinking stocks and equities. So that's one way to measure risk is beta. So this is about average risk, and this is a bit higher than average risk. That sort of makes sense because small companies are normally riskier because they're smaller. They're more likely to have really good or really bad things happen to them that has a big impact on them. Big, huge companies, it takes a much bigger hit, so to speak, in business terms to move their business up or down. So you typically expect collection of small companies to be riskier, more volatile than a collection of large companies. Excuse me. Here's another measure of risk, and this is a standard deviation. By the way, both these numbers were computed over a 3-year period. And that just means, compared to the average return over here, how much variation around the average is there. And I believe they do this on a month-to-month basis. So they take the value of each of these at the end of each month for 36 months and measure, and I won't go through the standard deviation calculation. It's, pretty basic statistics. You'd get that in a statistics course. But it basically measures how often or how far away this return is from the average on any given period of time, I think monthly basis. So this is sort of a relative risk to this, measures the risk relative to the overall stock market. This is more of an absolute risk. If you own this stock or this investment, and you value it every month or week, you can pick whatever period you want, how much is it going to vary week to week or month to month? And again, you can see what you would expect, that the large company index fund had a less volatility, varied less relative to the mean than the small cap fund. So that's consistent with the beta here. But what's neat about standard deviation is then you can compare it to the other types of investments like bond funds. So you can see here the bond fund was quite stable, only had a standard deviation of 2.9%. The return only had a standard deviation of 2.9% versus the average. So, but the return was a lot less. So this is the basic, you can see right here, the basic risk return trade-off. The investment that had the highest return also had the highest risk, both by beta and by the standard deviation return. And you can see this bond fund, although it had a very low return, also had a far less risk in terms of the volatility than the stock investments. So by the same token, I wouldn't really compute a market portfolio average beta, but you could also do a weighted average standard deviation, and you could consider the standard deviation of cash to be 0. And that would give you a risk measurement. So that's sort of the backwards way, historical way of looking at risk and return on the portfolio. You could also do a forward-looking way using the capital asset pricing model. which you may recall that I'm using my own abbreviations here, but the expected return is equal to the risk-free rate. So this is the rate, risk-free rate, plus the risk premium, market risk premium, times beta, this number up here. So beta. So this is just saying that if you own an investment, you would never want less than the risk-free rate, because why would you ever invest in something that you expect is going to return less than a absolutely risk-free investment would return? So that's sort of like the base, the absolute minimum return you'd want. The market risk premium is, again, typically applied. People discuss this in terms of stocks and equity type investments, but it is for an average stock, let's say in this case, for an average, what return beyond the risk-free rate would you expect? And then beta, as we discussed up here, is the volatility or the risk relative to the average stock. So if this is the return on that average stock, and you've got, for example, this small cap index fund that has a beta of 1.2, well, because this small cap fund's riskier by both measures than the large cap fund, you're going to want more, you're going to expect to get more return on the small cap fund to compensate you for taking that additional risk. And in this case, 1.2% more. You'd expect the market risk premium times 1.2, not 1.2%, but 1.2. So let's plug some numbers here. I looked up some numbers from a website called market-premia.com, and it is saying that the risk-free rate, typically you use government bonds, U.S. government treasury bonds of around 5-10 years, and they computed the market risk premium, which is a statistical calculation I won't go on into, but it's what this infers is for the average stock. If you owned, actually this index fund is easy because it's got a beta 1, so it's just the risk-free rate plus the market risk premium, then you would expect, let's see, this is 6 plus 1.4, 7.4%. So you could say the expected return on this S&P 500 fund is 7.4%. And you see that's a lot less than what it actually has done over the last 10 years. So that's implying that the market is implying that returns over looking forward are going to be less than they were over the last 10 years. And you'll hear a lot of commentators agree with that. Now, if we were doing the expected return on the S&P, the small cap fund, we'd use the same risk-free rate, 2.7. We'd use the same market risk premium, but because the stocks are riskier, we'd multiply it by 1.2, the beta. Since we're taking additional risk, we want more return. So that comes out to be 4.7 times 1.2. This is 5.64%. Add the 2.7. And you get 8.34%. So I'll just round that to 8.3%. Now, it's typically you don't use this. You can, in theory, use this for bonds, but typically people don't. But that's just another way, more forward way of looking at returns. You can see it's very different than the historical returns, so that begs a lot of questions. Well, are these assumptions correct? Maybe the market risk premium is actually much higher. Because there's lots of different ways to compute market risk premium. Or maybe this is an accurate reflection of what the market as a whole is telling us, that returns, yeah, last 10 years has been a good time to own stocks, because it started in 2009 when stocks were still headed down a little bit at the very beginning in 2009, but for most of 2009, that was pretty much right after the market crash. That was a very low point in the market. And now in 2019, we're at a very high point in the market. So this is telling you, okay, this fund returned almost 15% over the last 10 years, but don't expect that going forward. This was an unusually good period, is what you're seeing here, or that's what the market's estimate is. So that's just a way of looking at risk and return for a sample portfolio. You could compute a weighted average return here. If you wanted the more forward-looking approach, I think for now you could not get too fancy, but you could use for the bonds, the 10 years looking backwards. Bonds are not nearly as volatile. There are other ways to treat the bonds, but for this purpose, I think you could do the bonds using the 10 years. And if you did a weighted average of these returns, which is going to be a much lower number than this weighted average, that would be a more forward-looking expected return on the portfolio. And my sense is this is certainly more conservative. It's going to give you a much lower number here than here. But here we did sort of cherry pick an unusually good beginning and ending period for stocks. So I don't think it's unreasonable to say, yeah, this is about as good as it gets. We're unlikely to see this sort of return over the next 10 years. Might happen, good, but unlikely. And so this is a more conservative number, and a lot of people would argue a more realistic number. Okay, that's it.